Joined by Ed Rogers, the CEO and CIO of Rogers Investment Advisors.
Good morning, Michelle. Thanks for having the show.
So, Ed, Japan's first quarter GDP coming in at 0.6%. What's your reaction? Are we seeing signs of a bit of a recovery here?
Yeah, well, our reaction is we're not really surprised. We've been telling people for over a year now, you need to be patient and you will see the signs that you're looking for. This annualizes out at a little bit over 2.5% GDP growth. So if we've got that 2% inflation target in mind, which we always do, that's the target that the Abe government set 2 years ago at the start of the Abenomics program, it looks like we're heading in the right direction. As you noted, the sales tax was a pretty big speed bump last year, but we seem to have gotten past that and we're heading exactly where we've been telling our clients we're going to head, which is in the right direction.
Well, Ed, another sign of heading in the right direction, machinery orders rose 2.6% in March from a year earlier, up 2.9% for the previous month. Is most of this economic growth attributed to the weaker yen, which is certainly helping with exports and industrial production?
There's no doubt that a weaker yen has helped, but as noted in just the previous segment, becoming a true manufacturing superpower is not easy. It's not a simple task to create high quality manufactured goods. And frankly, Japan, Germany, and the United States, those three nations have, for the last 50 years, truly outdistanced all the rest of the competition in consistently producing a wide variety of high quality manufactured goods. People will pay more for high quality products. The Japan machine tool industry, for example, for the last 50 years has been a world leader. Whether the yen's high or low, it doesn't matter. Certain products, certain manufactured products are always going to sell well if they are high quality products.
All right. Well, last week, Governor Kuruda maintained his optimistic view on inflation, saying he didn't see any immediate need for further monetary easing. Some analysts disagree, saying that we will definitely be seeing more stimulus from the Bank of Japan. What do you think?
I think that the Japanese government has been the most open government in the world, literally, for the last 2 years about telling the public what they're going to do. I think you should take Governor Kuroda at his word. I think he's telling people, be patient, things are going well, the process is working. We tell our investors there are 4 words you need to remember. The first 2 are be patient, and the second 2 are get exposure, because the vast majority of investors still do not have exposure to the Japanese recovery. So the Bank of Japan has done what they needed to do, and now they're going to wait and see the positive results.
Well, speaking of exposure, the Nikkei, if you've been exposed to the Nikkei, you're doing very well because it's up 15% year to date, up over 42% year over year. Where do you see the market moving, and do you think this rally is fueled by real fundamentals?
Well, we've been investing in Japan for over 9 years in our Japan fund, and frankly, over the last 9 years, we've beaten the TOPIX by 40%. We think Japan remains one of the easiest places in the world to discover value. It's very overlooked. A lot of analysts over the last 10 years, they've been focusing on the emerging markets of Asia, so China or India. We think that's a bit of a mistake. You can deploy a significant amount of capital to Japan tomorrow and continue to participate in this economic recovery at a much higher level than you could get exposure to a country like Thailand or Indonesia, where the stock market's dramatically smaller, quite honestly. So we do think that this rally is set to continue. We think that the hedge funds that we invest in are the right way to do that because you're very protected on the downside. And we think that those people who do have exposure to Japan, particularly when you compare it, for example, with the United States right now, which seems very top-ish, are going to do very well this year and next year, to be perfectly honest.
Okay, well, let's focus on the near term. Bank of Japan is meeting. They're going to conclude their meeting on Friday. What do you expect to come out of that?
Same as the last few meetings. We think that the Bank of Japan thinks everything's going fine. There's no problem, so don't fix it. We think that they'll stand pat. We don't see that there'll be a move, frankly, in any direction on rates.
So it's safe to say that the Japan stimulus program is working at this point in the expansionary cycle. Has the economy successfully escaped deflation?
Well, there's still a question mark there. I think it's absolutely the right question to be asking. And I think that we'll feel a lot better if we see sustained 2.5% to 3% GDP growth. We see sustained inflation in the 1.5% to 2.5% range. But we need more time to see that happen. So it'd be very, again, we understand why many analysts would say, look, this isn't a recovery story yet. We disagree with that view. We think this is a recovery story in progress. But have we reached the finish line? The answer is absolutely not yet.
Okay, a recovery story in progress. Thank you so much, Ed Rogers, CEO and CIO of Rogers Investment Advisors. Phil, it's over to you in DC.